Before the break, we shared with you some of our exclusive interview with Manulife CEO Gori. The company has enjoyed solid traction of late. The current interest rate environment, while a tricky one for Canadians, has helped provide a lift to Manulife's business. We talked with Gori about the outlook for interest rates and his views on the best path forward for Canada's economy. Meanwhile, beyond insurance, Manulife has a major wealth management arm, and we started by getting an update from Gori on its performance.
We have a unique wealth management business that's quite different to many of our competitors. It's different because we operate across three business lines. We have a retail business line, we have an institutional line, but we also have retirement. And then what makes us also very different is our geographic footprint. So we operate across Canada, the US, Asia, but also Europe. So that combination of geography and business lines makes us very unique, and it's allowed us to deliver positive net flows in 13 of the last 14 years, when most of the market's seen net outflows. Now, more recently, we've seen equity markets picking up, and obviously that's creating some sense of optimism. But at the same time, there's still this big concern around inflation and interest rates and where that will land. Now, ultimately, I believe that we will see some rate cuts, but I think long end of the curve, the longer rates are still going to be elevated, and they're going to be higher. Now, historically, if you go back beyond the last decade, the rates that we're seeing today aren't abnormally high by any stretch of the imagination, but that's certainly putting pressure on companies. So I think that as we look to the future, what most consumers and companies will want to do is to look to diversify their wealth, and therefore a combination of investment opportunities that go beyond just bonds and equities, but also look at privates and alternates, is what consumers and corporates are looking for. And our capabilities really are front and center on that agenda, and we think we're really well positioned.
One of the things we've heard from some of the analysts and investors who like the Manulife story, outside of freeing up more capital, looking for generating some shareholder-friendly developments like stock buybacks, is that in an interest rate environment like this, it's not necessarily a bad thing for the business of Manulife. Can you just sort of set the record straight on optimally for a business like yours, what an environment like today means versus the low rate environment we're coming out of?
Yeah, John, you're absolutely right. Higher interest rates are a bit of a tailwind for our business and our industry. And therefore we are quite an attractive play if you believe that rates are going to continue to be a little bit higher than what we've seen in the last decade. Now, we've hedged a lot of our interest rate exposure, so even if rates go down, we stand to fare very well there. But higher rates provide still an opportunity from a profitability perspective, but also from the perspective of making our products look more attractive to consumers when they're looking at other alternate options. So interest rates and the current environment where we're seeing a higher for longer certainly a tailwind that will, I think, create opportunity for us and for our shareholders.
Now, Manulife has a large portfolio of commercial real estate as well. The nature of that portfolio makes you less sensitive to what's happening in the mortgage market every day just because of the ownership structure. Nevertheless, the interest rate environment is in part dictating pricing within commercial real estate. Plus, we're still coming out of an environment where some people want hybrid work. You've talked a little bit to Wall Street and Bay Street about the performance of the portfolio and your outlook from here. Can you reiterate your thoughts on the commercial real estate side of the business?
Yeah, so real estate's been under some pressure, especially over the last 12 months. Work from home certainly hasn't helped, but also higher rates, which means that the capitalization rates or the cap rates create pressure on valuations. Now, when we think about our investing portfolio, we look at our portfolio from a very diverse mix of industries that we invest in. Real estate as a category has actually reduced as a percentage of our portfolio over the last decade. It used to represent about 50% of our portfolio, and more recently it's actually less than 30%. So our investment portfolio within alternates includes infrastructure, farmland, private equity, timberland, etc. Now, real estate's where there's been the most of the pain in the last 12 months. We've seen valuations, especially in the office space, both in the US and to some extent in Canada, come down. We saw the peak of that pain in the second quarter of last year. We update our valuations quite frequently, and we've seen a gradual improvement quarter on quarter, and we think that improvement will only continue. And quite frankly, the higher cap rates actually bode well for future returns from the real estate asset class itself. So we do think that the worst is probably behind us as it relates to real estate as an asset class, but we have a diversified portfolio and we're seeing other parts of our portfolio doing extremely well, infrastructure, for example, as an example.
All right, so at the end of the day, a lot of that tailwind is now being reflected in your stock. It has, I believe, gotten to levels we haven't seen in 15 years. How do you feel about that you've sort of been working on building to get to this point and it's now being more reflected in the market?
We obviously feel good that the market is reflecting the hard work that the team's put in over the last 6+ years, and that's now reflected more in the stock price. But the honest truth is, we feel that the best is still ahead of us. And as I look to the next decade, there are 3 big megatrends that are shaping the global economy. You see a growth in the middle class in Asia. There are about 2 billion people in the middle class today in Asia. And that's forecast to grow to 3.5 billion by 2030. We also have an aging population. The current retirement gap, the difference between what people currently have saved for retirement versus what they need for retirement, is about $100 trillion. That's forecast to grow to $400 trillion by 2050. And then thirdly, the trend of digitization. Consumers are now wanting to engage with each other and with corporations in a much more digital way. So our unique business and geographic footprint, we think, is incredibly well positioned to capitalize on those 3 megatrends. And therefore, as we look to the next decade, we feel very optimistic that there's tremendous opportunity for us to not just grow and outperform our peers, but to create significantly more shareholder value as well.
And before we wrap things up, it kind of invites a question around the outlook for Canada's economy. Same issues at play here, an aging population, everyone trying to figure out how we grow the economy for the long term, how you attract foreign capital. What do you think is the best way to go about doing that for the country?
Well, I think Canada is at a crossroads. I think at the current point in time, we really need to focus on productivity, as you mentioned earlier, and GDP growth that's founded in a competitive advantage versus other countries. I think we will navigate a soft landing. I think that's something that's very credibly expected in the market. But the bigger issue for us is, how do we improve productivity? And I think at the core of that will be a focus around innovation, around creativity, around technology, which is what has made Canada great. Some of the best inventions and innovations in the world have come from Canada, and that's been a core part of the culture. So I think that needs to be where we continue to focus energy, and ultimately that's going to lead to the productivity growth that I think we need to see.
Who is responsible for that? Is it a mix of business and government? How do we get there?
It's clearly a mix of both. We can't lay all of this at the hands of government. I think government has clearly a role to play in relation to the vision that it sets for the country and the policies that underpin that vision. But corporations and companies like ours need to step up to invest in the country and in the quality of the capabilities that we have, including the digitization of our businesses, for example. But that needs to be a partnership that is much stronger than it is today.